So, welcome to the Quantitative Brainstorm Clubhouse. Today's topic is strategy ideation. And as always, I will start with the disclaimer. This is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. All right, I have a bit of notes to help kick this off because I do think it's probably one of the most important parts of a systematic or quantitative trader's portfolio. And I mean, it's also the most ongoing process that you go through as a trader. And I have kind of three categories where I really get my ideas from. The first one is domain knowledge. Knowing the markets you trade, knowing how things work, knowing the participants that are in there, and knowing how they potentially can interact is a good, always a good area to start. And the next is I have written is written work. I suppose you could include podcasts in here, but I do get a lot of inspiration from blogs and Twitter, to be honest. I mean, FinTwit has some really smart characters in there, but also academic papers. And I know Jerry had posted a quote from Campbell Harvey, who I follow his publications quite fondly. That's saying, I think it was a small percentage. I don't remember exactly the percentage, maybe 50% or less of academic papers are replicatable. On this topic, I've actually found probably only 20% are replicatable. So it's a much smaller amount than he found. Even some of his own papers are not replicatable. So I thought that was quite funny because I've tried to replicate quite a lot of his work. And then the third would be experimentation. So I use something called the second brain, which collects information that I'm reading or consuming as a productivity tool, but also collaboration, working with other teams who have maybe discretionary managers. They probably have intuition in a market that something is going on that they're exploiting. They probably just can't quantify it. And if they are following rules, the chances are that you're able to translate 60 to 80%. I'd say 80% is probably the ceiling of what they're doing because they do have some variability in their decision making. And transferable knowledge from another domain. And I classify this as experimentation specifically because you're not sure how exactly to apply this new information. I think that's why the first principles thinking is quite important. And the first principles thinking also applies to written work, finding networks of works that are pointing kind of to the same idea or distilling a written work to what they were trying to target and not necessarily using their implementation. But I think that's probably where the best alpha comes from because it won't be published. It'll be a new way of thinking. And I will tell you, I'm probably not that smart to be able to transfer so much external domain knowledge. But I have found some teams, and that's why I think a lot of firms hire a lot of straight up scientists, PhDs, things like that to bring in the other domain knowledge. Because I find if you're surrounded by people who are all in the finance industry, you tend to get like, I don't know, idea incestuous. Things start to go around and then they come back around and things like that. So it's really a good booster shot of fresh ideas. So now I'll open it up to the floor and people can kind of talk about where they get their ideas from.
G'day, guys. How is everyone? Yeah, that's interesting, Derek. I suppose the way I approach it is, I think to myself, so if, for instance, I want to examine a strategy or identify a possible strategy to evaluate it, the first thing I'd probably do is go to the academic research. So rather than trying to identify a new opportunity or a new edge, I'd be looking at academic papers that can uh, that demonstrate a technique that has a very long-term, robust edge, and so that's why automatically I slipped across the trend following. Clearly, there's a few particular strategies that can consistently demonstrate a strong edge over a very large range of or different market regimes. So that's what attracted me to trend following. Basically, this large plethora of academic research is a bit like. You often don't know where to start when you try and identify, well, what strategy am I going to deploy to extract an edge from this market? And I often think that probably the best way to approach it is to stand on the shoulders of others who've done the hard yards with the research to at least demonstrate that the technique itself has some enduring edge, and then you're therefore confining your system states to that which lies within this principle that the general technique itself is very sustainable. So that's how I'd sort of approach it, rather than try to identify a new edge, which I think would be infinitely harder. And I just wonder, from your experience, when you get together in experimental teams to identify a new opportunity, how many times do you identify a successful opportunity versus how many times do you sort of go down a dead end? I'd be interested to know from your perspective what sort of ratio you're getting there.
1 in 20, probably. Probably academic research replication, pure and simple, just trying to see what they get from a paper, 10%. Going down a new path, I think actually pays more dividends, even if you fail, because uh, you fail forward, as in, that this idea may or may not apply, or it might not work out how you think, but it's expanded in an area that doesn't have so much documentation. So it's like, yeah, you fell down in the forest, but you're in a new part of the forest. Um, I I think that I work more iteratively. I don't really try to come up with something new. I found that it's easier to put a new idea from an experimental team to improve something in a different way, because then it's less freeform. You know what you're trying to optimize for, you know what kind of is the target, and you're using a different tool. But yeah, I would say maybe if I'm just doing something purely, oh man, less than once a year, I really hit a breakthrough, to be fair.
Yeah, one of the key things I think that is important, which you've highlighted obviously in your approach, because I think you do this the same way, is you first identify the opportunity or the edge you wish to extract before you sort of undertake any testing or examination. So, with this plethora of data mining software available, it's too easy to sort of just chuck that software onto a data set and say, these are the performance returns I want. You go ahead and extract the edge with a solution that is optimized and data mined. I much prefer a design-led approach where um, you use your creative brain to identify the opportunity. You then identify the system and its constraints that try and target that opportunity. And then from there, you might apply sort of weak forms of optimization to identify the parameters to use for the variables. But the definition of the variables, the definition of the design is a creative process done by a human brain, as opposed to a data mining process. Do you strongly agree with that?
Oh yes. Um, I come from the ideas based, hypothesis based approach, which is why, kind of the things that I mentioned are all like preloading my brain with stuff. It does have implicit bias, because if I'm picking this information up from someone else, so say like written work or domain knowledge, there is probably some filtering that's already been done. But I find it's very important to figure out the narrative. And I find it's very important to find out who's the other side of the flow, or try to do as best you can. Yes, it's a complex adaptive machine, but I want to try to visualize what is the other party doing, or what market reaction feedback loop, or on the other case of feedback loop, who else is bringing things back into line. Uh, I do have a step that's in between what you mentioned, Richard. So, like, if you imagine I have an idea, I don't actually work with real data first because I don't know if the way I'm trying to capture this is right. And especially if if you have a couple of academic papers or a couple of blogs talking about the same thing, they may have implemented it slightly differently. For me, what I do is I go into my, like, I call it my laboratory environment, which is a purely synthetic data environment, and I try to create uh, some kind of system or strategy or signal or however you want to put it that I believe will capture that phenomenon, and then I try to create um, different types of time series where that phenomenon should exist. And then I can see how my idea captures this other I like this on this fake time series. So I can try different implementations before I even touch real data, and this gives you massive amounts of sample size because not only do you know the boundary conditions of your implementation, you also know its weaknesses before you even see the first back test or the first trade statistics. And I find that extremely useful because it's a free sandbox. You are always constrained by the data sets that you have if you're always using real data. And to be totally free, to know I have infinite data, to try infinite ideas with different amounts of this phenomenon existing in that data set. Uh, Honestly, I mean, it's quite fun. I feel like a kid in a playground sometimes.
Great idea. Thanks very much for that.
How much do you pay attention to themes and the overall undertone of markets? So one thing that Niels is in his main podcast is talking a lot about is, for example, ESG. So how much of those sort of big ideas that are floating around influence your trade idea or signal generating process?
Okay, that's a good question. Um, it depends. And I will say it depends because for myself, the products that I'm responsible for, themes don't really matter that much. It's more so I'm looking at it as what is my portfolio missing? What types of strategies will fill in the gaps? Which ones could be, what could I add to make it more diversified or whatever in my multi-strategy portfolio? So I'm kind of like working from I want to create something that will make this better or optimize a single strategy in a different way and like kind of come back to it and do a version 2.0. If I'm working with another team and they have a specific target for something thematic, then I will do that. On the converse side, I do put my strategies into families. I do have my kind of like internal mental framework of what factors they're going after, what phenomenon they're going after, and I might have multiple strategies doing the same thing. Like I know we always come back to trend following. I try to avoid it in these conversations, but it's a perfect example. That is a family of strategies. You can implement it an infinite amount of different ways. You can put lots of different parameters. You can be, short or fast. I mean, slow or fast. But to me, they're all capturing the essence of the same thing. So then you might do another family, which could be yield generation strategies. You could think of carry. You could think of things along a curve. You could think like that. And to me, that's how I break down stuff.
I'd be interested to know if Jerry has ever sort of experimented with other strategies apart from trend following.
I'm anticipating his answer, but I think I know what it would be.
I think he might be guzzling on his wine at the moment and not here in spirit.
Or feeding birds?
Oh gosh, are you guys talking about me? I turn around for 1 minute and to feed my dog.
we were
So,
saying, I was just wondering whether you had actually ever experimented with other strategies apart from trend following strategies.
it's funny you bring that up because I remember when I first left the Turtle program and I started trading on my own. CQG had this. I got a CQG, which was the ultimate. I had never heard of Bloomberg, but 1988, I did this CQG, and it has this moving average configuration on it, and I study and I put it in there, and sort of by hand, I start with this short-term trading system, and by hand, I put in the buys and sells, and this thing, maybe a couple of day holding period or whatever, it makes money on almost every single trade, and I'm totally shocked by this. And then I figure out later that it uses the price of a couple of days hence. So if you go back in history, on Monday, it's actually using Wednesday's prices. So who in the world creates a moving average like this with this capability? I have no idea.
That's happened to me as well. It happened to me when I was experimenting with some fairly high frequency trading systems, and I was undertaking my tests. And they were glorious tests, of course, until I realised I was operating within the spread that my brokers provide me, and then I realised why they are so spectacularly successful. So I had to go back to the drawing board with that one.
But I'll pick up on what you guys were talking about. And of course, from my point of view, I don't usually make many changes to my systems, and I'm not really interested or have time enough to think about other things other than trend following. But so I'm pretty obsessed with reading and trying to find other opportunities, markets, mainly to trade. So I have 700 Google alerts, which I have to set up rules for to filter the right ones, the most highly profitable ones, hopefully to me on my inbox. And then I'm reading about trying to find like a new opportunity set. And so recently, with so much crypto in the news, I'm wondering, is there something other than just flat out Bitcoin and Ether futures? Is there some sort of DeFi industry and companies popping up that I can get a pure play on something different? So I am kind of almost always focusing on just trying to find a new opportunity, and I'm going to apply those same systems. I can't imagine changing them very much at this stage, but that's pretty much. And within those 700 Google alerts, I have Derek's name, Richard's name, all the famous CTAs and hedge funds, and I'm trying to see if there's anything out there that people are saying or doing or podcasts where I'll get a little nugget of wisdom. And I just started looking deeply into these 13 Fs that everybody, a lot of the funds have to file that shows their stock holdings, to sort of go through those and see what people are thinking philosophically. What are they buying, and what industries and sectors are they into, and is or something I need to look into.
Yeah, I think it was Meb Faber had a strategy where you just use the 13 Fs of Warren Buffett's disclosures to sort of construct your portfolios to try and replicate him. I have a feeling it did quite well, that strategy, but yeah, my memory's fading.
I think that that's an interesting point, these 13 Fs. And I will bring that back actually to the commodities and the like commitment of traders reports. I do think that there is something there. The issue is uh, getting the parties. So it's like picking a Warren Buffett 13F is probably pretty good because the turnover is really low. Picking, say, a Renaissance or something's 13F, probably not so good. But I haven't looked at it. But it does seem like an interesting source of alternative information.
A 13F from a year ago would be valuable to me because I just want to see what they were thinking at the time. And I'm looking for something philosophical, not a tip. not something that they think is hot. I'm thinking like I'm going to trade this market or ETF sector, uranium, lithium, ESG type stocks or whatever. I'm going to trade this for the rest of my life. And I'm just picking up on ideas and making sure I don't miss something. One of the things I think it's very interesting is there's a couple of CTAs that talk about trading a lot of markets, hundreds and hundreds of markets. And they also trade stocks. And I see in their 13Fs that they're very big into these sector ETFs, all kinds of ETFs. And they may have anywhere from 50 to 200 stocks on, at the end of the quarter. And then if you look at some of the famous hedge funds, they may have up to 1,500 stocks. So it's really baffling to some degree when you see that, because you're like, how can you get anything other than the index if you're going to have 1,500, 1,200 stocks on? So there are people out there who are right with us. They may not be talking about it on podcasts, but they're with us when it comes to massive diversification. And of course, I can't really see how many people are trading the commodity futures and currency futures, but I wouldn't be surprised if some of these hedge funds are their diversification seems to be pretty impressive, at least on the stock side.
I think the equity space is the most well known of this kind of like strategy thing because of all these public filings. I was never an equities guy, but I was always kind of jealous on how much academic research has been done on equities and also how many public filings of large funds there are. It's not like I would say, yeah, CTAs or anything where you kind of have to guess what their sector allocation is on their quarterly report or something. I mean, it's not the same. So I'm really curious if you've had anything stand out to you, Jerry, after looking through so many of these.
Well, it's kind of weird because sometimes you'll see a large hedge fund, rather than take a position in gold or crude, they have bought the ETF, which I find to be a little strange. It's almost like we have so much work here, so many markets to take care of. We don't want to do the rolls each month or each quarter, So from an administrative point of view, let's just pay 50 bips to a ETF provider so they can do the work for us. And it's disappointing to see those CTAs I talked about, that they will, I'll look at especially theirs because they're sort of philosophically aligned in the trend following. And so when I see what they're trading is, I'm looking at those ETFs. What sectors are they in? And but they're content to trade the sector. The ETF uranium or ETF steel, cobalt, water, um, wind, the wind ATR, all this sort of ETF, all those sort of things. Versus I'm going to go in and pull out of those ETFs a stock or two that I think will be kind of representative, a good representation of that sector, and try to get just trade that individual market and not trade the ETF itself, because I want to maximize this asymmetry and this possibility of an outlier. So it doesn't seem that. And I guess another thing that pops out too is if something's in the news, like Bitcoin or um, maybe something like a popular ETF category, like half of all the funds will own it. It's like a lot of duplication. Everyone kind of knows this is something interesting. Let's all get on it.
Jerry, this is something that I had asked via Twitter to you and Niels, and that's with respect to your single stocks, and it does pertain to ETFs, although not to the degree. And that's when you're in your long-term holdings and you receive dividends, do you put them in a pot for redistribution, or do you reinvest them into the equity, and if so, do you do it immediately or at the quarter or during rebalancing? How do you manage those?
I don't adjust my position. Maybe I should, but I don't adjust it. I just sort of treat that dividend as like I would interest income, and I just go on my merry way. Then I do, of course, adjust the stock price for that dividend to adjust my data. You have to do a continuous contract for futures. You have to do this dividend split adjusted contract data for the stocks. So I have a simple question I was thinking about the other day, and I hate to ask questions like this because it does make me sound like I'm super smart, but I'm short some of the an ETF or two, some of interest fixed income ETFs that are in a downtrend. And I was thinking that the expense, the management fee, it seems, actually um, maybe helps me because the price is always going lower due to this small management fee. So I think it actually helps my short um, a bit. I guess it obviously gets deducted from my account, and so I guess it's a kind of a wash. But it's just kind of funny that this deterioration, small deterioration in your value, actually pushes the market down a bit.
Yeah, I think that that's interesting idea, taking into account of fees. I think it's just kind of being aware of the instrument you're trading. To me, I think it's just basically almost like a carry strategy. You get the extra bonus carry of them shorting your um, NAV, right? Because like on the daily, right, they'll amortize it over like whatever time. So on the price, it will be reflected uh, and to your benefit, which I think is actually quite cool. I had never considered that before because I'm not an equities guy, but that also could mean that you will get short signals more frequently because potentially there's that slow grind down. It's almost like you have the continuous futures with the roll down or something, and it um, the management fee wouldn't be covered necessarily when you do dividend adjustment. So I don't know. That's just something that came into my head. I'll pick on Bruno P. Maybe he's around. I did close his mic because I didn't know if he was here, but I'm curious to hear how he approaches research and doing strategy ideation. I know he's kind of a multi-strategy portfolio as well.
Yeah, I've been very quiet, usually, unusually quiet, because I find very, very difficult to add to everything you guys said. So yeah, I mean, I'm going exactly your way, modulo this idea of thematic investment, which I'm getting quite interested in, even if, as you said, I don't particularly run a portfolio of themes, but it seems like ESG is everywhere. So what is ESG and what are the implications for even a trend following portfolio? Likewise, Jerry said crypto obviously, hell, it's all the rage. Another big idea of mine, again, Jerry sort of hinted at that, is DeFi. And in this space, I try to engage with a couple of firms there that are sort of trying to start up as crypto banks or stuff like that. It's very, very difficult though to find somebody who's interested in structuring to come up with a product that sort of develops and embeds a lot of the trading strategies. For some reason, they prefer to offer certificates or sort of tokens and stuff like that. They don't think about packaging up a strategy. So there's been probably a little bit of frustration, but I keep going and um, I keep chipping away and trying to find out if anything works there. Volatility, of course, is my obsession. So how to integrate, and again, I'm gonna do an Oleg here and call out the excellent podcast that Niels had this week with Harry about volatility, and the point he was making: trend following versus volatility. When is one strategy better than the other? So the sort of relative value between implied volatility and realized volatility, and therefore, playing the strength of more pure vol plays versus trend following. And lastly, I'm very interested in equities, and as I was talking in the podcast last week, in Jerry's podcast, unfortunately, I've not been any good at developing anything there because of what Brian was talking about, all these dividend adjustments. And yes, you can treat dividends as a Panama, as what we do with Rollman, Panama method and stuff like that. But then there's the reinvestment theme. So I managed to confuse myself a hell of a lot in equity space, and so I've not been as good as you guys in capitalizing some of these ETF trends. I totally second what Jerry says. You should tease out a couple of performers, outstanding performance from ETFs, but I don't know how to trade in single equity space and make it a valuable strategy. So this is what I'm thinking about right now. Apart from totally epic fail in equity, I'm very interested in vol, very interested in this new finance, so tokenization, DeFi, and stuff like that, and of course volatility and trend.
I'm totally going to dig in on those two big open doors of vol and crypto, because I do I mean, okay, in the vol space I think we have established managers, but in the crypto space, again, we're in this zone of um, less written knowledge. People in the domain have maybe been in since 2016. They can say they're that, or there wasn't really any big players before that. I mean, maybe you've been mining or whatever, but it's a quite green field in the factors strategy space. So how do you approach that versus the vol space? And the vol space, I mean, I have my own views, but I want to hear what Bruno has to say.
Well, yeah, I mean, I think we are going to probably we're down the same track once again. I was trying to hint at what I'd be very interested. I'd be very interested if there was a crypto provider that sort of bridged um, the crypto space with the cash space. So, for example, on there's an obvious trade in Bitcoin futures that is contango versus backwardation and what it does. I mean, that's a clear signal for where the price is going. It's a lot more predictive in crypto space than in other futures. The problem is you can't short in a crypto future. It's really expensive in terms of margining. And being able to give a fiat broker your bitcoins is not going to happen. But if there wasn't somebody that said, "Okay, I am going to take your cryptos and use that to margin your future," you would see your ability to monetize that fat spread, either doing the cash and carry or the reverse, very easily. And of course, that will spell the end of this wonderful arbitrage. But it frustrates me because I would like to do it and I've not been able to do it.
That's interesting, because the only places that will allow you to do that are the unregulated exchanges.
Yeah, exactly. And you probably don't want to go there.
It depends how much you like your counterparty risk versus, whatever annualized return, right?
Yeah, no, exactly. I mean, it's all exactly. I'm not interested in becoming a sort of a credit agency and say, okay, these exchange is more secure than the other. And it's how can you do that? And plus, fiduciary responsibilities and all of that. So as I said, I try to engage with these new banks. I'm not going to name any names, but Switzerland. It's a shame that Niels is not here, but Switzerland has a lot of new players, and these are banks, regulated banks with bank licenses. And I've talked to the head of trading, and we all agree that it's a good idea, and then we can't make it happen. And so of course, I don't have enough traction and enough market clout to say, okay, here's we're going to make it happen. But if some of you have it, I think is a fantastic opportunity.
I do think that the structured market is probably the new thing in crypto, the financialization of it. Um, and it's funny because what we're talking about, and I know Moritz has talked about it on TTU and the whole thing, but this transferring, kind of bringing it back to this idea of strategy ideation, we're transferring traditional finance ideas into the crypto space, and they tend to work like really well until there's mass adoption of it. So I think that's a brilliant example of a very simple strategy that executes pretty much the same as you would expect it to in the traditional world, but just has a larger edge because of a more nascent market. And I people are pushing. Yeah, I think I know the people you're talking about, Bruno, in Switzerland.
Yeah, of course. I mean, I'm not naming names, but
Yeah, and
I've
Singapore
been
is
quite
trying to make a
explicit.
bit of a push. I will say, but I don't know who is more conservative. I think Switzerland is probably winning this race. To be honest, from your
Well, you're part
perspective,
of the
what is the
world
demand?
too.
Yeah, so I mean, I'm sorry. What do you think is the demand for that? I mean, from where you sit.
Uh, to be honest, I don't know. I mean, this is Jerry and Richard may have also good ideas because they also talk to investors. But if you went to any investor, you know, I tend to work more on private money and sort of, a collection, few clients, but well-heeled ones. Um, but if you went to anybody and saying, "Hey, there's this huge opportunity," as you said, exchanges are offering crazy APYs, so periodic yield on all sort of crazy products, shit coins, and all of that. Why don't we package up some really good solution that involves Ethereum, Bitcoin, only the major coins? Not we're not gonna do anything crazy. And instead of giving you a very volatile but huge return, we sort of give you, I don't know, a high single digit or maybe low teens return that on a packaged up in a product that has, if you want, certain set term or is a rolling product. I think there's a lot of people, even pension funds, I'd imagine, that can say, okay, yes, we like that. All I need, besides my very limited ability to conceive strategies, is having a credible partner that says, "Hey, I'm a big, licensed guy in Switzerland. I think Singapore looks really interesting. In these two parts of the world, that can say, okay, I am a serious guy. I'm not this idiot that thinks about crazy things and talks on Clubhouse. I'm a serious guy, and I'm putting my name on the product. But the strategy, I think, is not that difficult to package up, and it has a lot of it could be sold in lots of different ways to lots of different clients.
I think it's only a matter of time, Bruno. But we're probably a bit early for it. Yeah, we're in the infant stages where we want to jump on this opportunity, and currently there's not the products that allow us to do it. So it inevitably will come. I suppose we just keep our eyes peeled for those products when they arrive.
Yeah, I agree. But it's very interesting, what Derek was saying. How do you? So this goes a little bit beyond strategy ideation and goes into full-on product packaging, which is also very interesting. And you guys know that all copying each other's products and selling it up and down the street. So that's basically I'm copying their sort of playbook, but it's everybody's playbook. You don't need to copy it. You just need to go back a couple of pages and take things up from there.
Yeah, I find that quite interesting because I do think that, wrapping this kind of whole product idea into the strategy ideation part and, bringing everything back is when you start with the idea, you really have to know what kind of end product you're targeting, who are your clients and all that. We're as much product managers as we are portfolio managers. And to have that target client in mind, because in the end, you need some kind of money to back it. Unless you're just building it as a part of your portfolio, and then basically, your already existing clients trust you to come up with a new idea. But this is something I'm not very good at, because mostly when I come up with a new idea, I just wrap it in my current thing and say, yeah, I'm multi-strat. I've added a new strategy this quarter. We're more diversified. We're better. We have another return stream. Job done. But I want to, or maybe improve myself to be able to kind of like split off, individual themes or individual strategies, or like break up what I'm doing into multiple pieces. But I've never really done the legwork to do that. And then trying to identify clients that have all of the building blocks of potentially what is my main product. Like, does that cannibalize my already clients or what? I'm not really sure.
Yeah, that's exactly it, and it goes back perhaps to our main diatribe and our main let's call it fight, for lack of better words, with Jerry and Richard, as to whether classic trend following, a very pure strategy, is a viable business, or we should bastardize it as I've done, in order to create a business that serves other people, other clients. I lean in favor of yes, ideas first, as Rob Carver says. Always start from first principles, as you say, which is exactly the same thing articulated in slightly different words. But then at some point, um, I am not, rich enough, powerful enough to say, sort of my way or the highway. So I have to sort of, corrupt my morals and bend rules. So, I am violating Jerry's and Bruno C's number one rule, and Richard's let your profits run. But why am I doing that? Because I think I live in this world of geometric returns and blah, blah, blah. But, I have a business reason for that. And likewise, I would like to, corrupt and sort of expand my universe of products. Like, I think is one of Jerry's, if not the main skill of Jerry's, but one of Jerry's many skills. And I'm really looking up to him and trying to apply it as much as possible. But then again, I don't do it in isolation for the sake of doing it, to pursue some sort of wide portfolio, high number of line items in my portfolios. But I do it because I think about anything that offers a diversified stream of returns without crazy dips and crazy jumps in that return profile. It works. It's really a good idea. It works really well. It's obviously easier said than done, but that's why I'm looking at themes as well as strategies and try to sort of develop everything in conjunction. Nice theory, I know.
Yeah, once again, it was a good podcast with Niels, with Harry. He was effectively reinforcing what I think the topic we started with here on Clubhouse, on your Clubhouse, Derek, with the long vol, being able to offer a punchier return in the short-term space. And I've often, I'm starting to think, I'm just wondering if, for instance, we did apply some sort of long vol options play in tandem with our classic trend following strategy. Let's say we were happy with our medium and long term models, but we wanted something punchier for the short term models. And this is where Niels was discussing, well, perhaps we should be looking at momentum models. And then Harry was saying, yes, but there are two benefits we can achieve from long vol with options, in that we're looking at the changing nature of the premium itself, and also the convexity that that option delivers when it goes in the money. And I was thinking to myself, well, if you did apply some sort of long vol component to a classic trend following portfolio, what sort of percent of long vol would you be applying to a classic trend following portfolio? Would it be something like 10%, 15%? What would you say?
I think it's a harder question than that. I do options on top of the trend following component. Um, The issue is the changing exposure. So you can't say that I have 10% exposure to options today will be 15 or 5 or 8 or 9 because the delta is always changing. So it really requires a reframing of how you think about allocation to add nonlinear components. All I can say is it's hard.
The nugget of information which really lit me up on that podcast, Richard, was about exactly, was thinking exactly along the same lines as you. And I think Harry said that there is this spread between, realized volatility from a trend follower versus, implied volatility. Because if options are there to give you a kick when things start going haywire, and at the same time, your trend followers are sort of, getting a little bit lost in a way because signals weaken and you get stopped out and stuff like that. You should look at how to, temper one strategy versus the other relative to the crossover point between realized volatility of your return stream, i.e. your trend followers, versus the price of implied vols. So if you realize vol in your trend follower is higher than implied volatility, maybe it's time to do what Derek and I try to do with continuous signals and or volatility targeted and or actual option strategies. Certainly what I'm looking actively into doing. I haven't implemented because it's hard to build this sort of relative value framework. But if I had a clear signal that today, my trend portfolio is realizing a little bit too much vol, and while implied vol would be a little cheaper, I'd be buying options. And the other way around, of course, if I would under realize in vol on my trend followers, and implied vol would were to be a little high, I'd be very actively looking into sell volatility and sort of play this game like this. Quite how to build this machinery, I am I'm struggling a little bit, so I can't offer any wisdom, unfortunately. Only a lot of failures, but I think that's how to tackle the question and how to answer the question.
Yes, it was interesting. I was actually thinking, well, really, I'm only looking at something that gives me a bit of kick in that short-term move. So my medium-term and long-term models, when a correction or when we get this non-linear move, the medium-term, long-term, they really take care of themselves very well, but they do require these quite extensive price moves to deliver that non-linearity. But so I'm after, therefore, something that is just a quick hit when that volatility starts expanding. And I was wondering to myself whether it's almost like implementing a timing-based component for the options where you only invest in options when they're very cheap, and that typically is when no one expects the volatility expansion to occur. And so you're always protected. You're always sort of applying this small insurance premium during these times where the premium is very cheap. But as soon as that volatility expansion occurs, that's it for your options, and you start moving into your medium and long-term models. So I was just wondering if there is a role for timing to play there based on the discount you achieve on your premiums.
From my experience trading long vol, you must be tactical. So yeah, your intuition, Richard, is correct, because necessarily the person who's selling the vol is collecting their theta every day. You need to get your punchiness is a race against time. So I think your intuition is correct. The part that I want to tie these two ideas together, from Bruno and Rich, is how are you going to overlay the options into your strategies? I mean, okay, let's assume we have some kind of allocation. It doesn't matter what it is. But what's the purpose of it? Is the purpose of it to hedge out the volatility, or I would say capture different volatility from the implied realized of your trend following system, and going with what Bruno is saying? which to me means kind of like a delta neutral kind of strategy, or going into what Richard is saying, he's looking for some more punchiness, which would mean to me cheap directional plays. And then how you price and purchase those two things tactically um, are relatively similar, to be honest, because the vol will be the same if it explodes. If you have a call or a put, I mean, it's just put call parity. The idea is what specific Greek are you capturing? Because if you think that you want to take it directionally and your breakout ends up with a good move, you may not want to be delta neutral in the first place.
Yes. So, I'm answering your question this way. I'd be looking at vega versus theta. So, how much convexity on vol expansion, not on delta, movement. Obviously, you have to, hedge out um, the cross between delta and vega, but let's not let's not get too complicated. But I would be looking at that not in isolation, but relative to the realized vol of my returns. In other words, when I know that the market for options is giving me a better opportunity than what I'm doing in sort of harvesting the synthetic assets and the risk premia through my program, I should allocate more heavily to that market and deallocate to my strategies. The problem I struggled with is how to build that relative value model, because you're talking about, yes, the same volatility, but as you pointed out, is not quite the same, because we're not trading my own future strategies. You can buy S&P vol, you can buy Eurostox vol, you can buy all sort of fixed income and currency vol, but not that of your program, if it makes any sense.
Yeah, I think that's interesting, actually. I didn't finish the podcast. I was listening to it on the metro on the way home, and I didn't finish it. So I think I'm a bit behind on this, but uh, that is the point that I got from what you said, Bruno, was that you're looking at the whole vol of all of your systems versus the implementation of the vol on a single trade, right? Like you're pricing the whole vol of your entire portfolio and then saying like, is this total portfolio vol cheap or expensive? And then if this total portfolio vol is cheap, then I should buy as much options on all of the things that are underlying as I can. Is that right?
That's right. And let's think about in terms of stop loss. I am implementing the stop loss of my system much cheaply through options than I would be by trading my own position. So I don't need to sort of, pay away a lot of costs to trade out of my positions, relative to obviously options, because I'd be getting, as Richard puts it, a higher kick, which offsets my losses, my mark-to-market losses, when things move against me. And so, I sort of, without this dip in my traders' performance. And so, I keep realizing my returns targets without, impacting my portfolio vol, without paying the volatility drag too much. I'm always thinking in terms of vol for everything, not because I'm, a staunch believer in the Sharpe ratio. I am not because I want to be clever. I'm not, but because I firmly believe I live in a geometric returns world where path dependency matters, and it's not just a monetary cost, but it's also psychological cost. So if options come to my rescue and sort of smooth out the ride for me, I'll be loading up on those. Problem is how you price this volatility, and that's where I'm failing at the moment.
Yeah, I tend to prefer the use of options for that short play as opposed to what Niels was referring to with these short-term momentum models. There's definitely a bit more bang for buck, I think, in the option space than there is in the trying to seek sort of momentum models or short-term models that try and capture that short sort of directional move.
Something that we've been discussing is this options, and I think that um, okay, there's the vol component, but there's also the structuring component, right? Um, you're trading across this like huge surface, how are you going to systematically, pick the best one? And this is something that I have found to be quite difficult. Um, is automated execution of optimal structures. Uh, I still haven't found a way to have a computer optimize option structures, even using simple vanillas, to do that, to be able to execute against what you guys are talking about. Um, and I think that adds a bunch of complexity. It's not necessarily strategy complexity, so to say. Maybe it is if you think about, because you might have a funding leg or something like that. But it's not always optimal to pick the at the money, and it's not always optimal to pick any single delta, and it's not, it's like you're trading 3D space when you get into the options. Um, and I think that makes the implementation a lot harder. Yes, you can automate just buying the at the money call or the put for whenever you get your signal. I think so, but then you've got the portfolio of these things, and then how are you going to manage that um, with your realized vol of your portfolio of trend following? And then does it matter that you might not have positions on some of your trend following instruments? Maybe not all of them will be optionable. So like, how are you measuring the realized vol of your portfolio anyway? And then how much of a kick are you getting out of these short term um, systems, like as if you took like a short term system and you did it in option space? Is that short term expected value change in price move because you're targeting more the move and the increase in volatility? Hopefully your exception will be equities, except recently, vol up, spot up, to cover that premium cost, because it's going to be a bit until you actually kick into the actual in the money.
Yeah, so as usual, you are a million steps ahead of everybody else in, when we start talking about something. I can give you, some of my failures, and you're hitting the nail on the head. It's a massive optimization problem. So anytime, and one of my many sins is to use optimizers, and but I use them trying to never optimize parameters but optimize in white space. What do I mean by that? I don't look for the best option strike or the best combination of trend signals or the best of the best. I'm just coming up with something very similar because I'm adding complications, so I have to be I have to cut back and pay the price and pay the complication tax away by simplifying wherever I can. So think about few instruments. So the S&P, some of the fixed income maybe, and a couple of currency or volatility bricks. How do you combine them in a way that sort of offer some sort of ballast to the known pitfalls of trend following? That becomes a complicated problem, but a slightly simpler one. So I don't really, again, like with what I keep saying to Jerry and Richard, I don't try to optimize the outcome of every single trade I make. I try to optimize the outcome of my portfolio. Here in volatility space, I am trying to sort of trade very simple and very few strikes, as few as possible, and very few underlines. But still, it's a very complicated optimization problem, and perhaps one day we should talk about optimization in detail. But the optimization issue becomes quite heavy. So you have to use a mix of optimizers. You couldn't use only one, and those optimizers you sort of had to run a little bit of a race between them, and find the one that gives you the best, the sort of most viable answer in the shortest period of time, because otherwise you would be optimizing for years. And so yeah, it's like combining lots of different optimization techniques, figuring out which gets you the faster response, and then sort of being happy with that. That on average is going to be good enough. It's not going to be good enough at identifying every single combination of trades, but I'm really shooting for something that works in the long run, and gives me something that I'm happy with, not necessarily the best of the best I can get.
This is a question for both Bruno and Derek. What are you utilizing the vol? I don't want to call it targeting, but what are you utilizing the volatility component of your portfolio or strategy for? Is it alpha? Is it as a hedge to kind of reduce or improve returns during moves against the overall position? I mean, I think the strategy should be based on the why of the participation in the vol market to begin with, because I think particularly with options and the fact that options on futures behave vastly different than options on equity as far as the impact of price with span margining and whatnot. So I would be interested as to what your intent is for utilizing it, and then where you go from trying to begin to formulate your strategy based on that.
In my case, it's quite simple. Vol is basically, you can think of vol as the cost of doing business. Vol is something that diverts my actions away from reaching my goal. Is the drag, I'm trying to go from, think of a back test from, bottom left to top right with a smooth, I know Jerry is gonna explode in a minute, but with a smooth line as possible, and with the
Don't say that word,
steepest
Bruno.
the steepest angle as possible, because that's what I'm trying to do. I know that it's impossible to achieve that, but I still try to minimize this drag, and I have to do it by combining lots of different instruments, combining lots of different strategies, so adding diversification. But diversification has a cost. What is the cost of diversification? Again, if you live in a geometric return world, the difference between the arithmetic mean and the geometric mean is, guess what? A half of your variance. So, here, that's the link. That's the reason why I keep telling Richard and Jerry, yes, I'm really disobeying the rules, but there's an identity. There's something that brings everything back, and this is how you perceive the world. In my worldview, how you get there matters, not just whether you get there. And in my worldview, the game resets every night. In my worldview, I know it's not a problem because it's not, but every night we get margin, so we have to at least keep sufficient equity. So all these little things, all this moving around of the portfolio is something that I need to pay attention to. So more to the specific of this strategy, I would like to actively use volatility to sort of play the game between trend following and options. And when volatility is cheap in option space, use that as a relative value, allocate a little bit more to that, because you're going to get there. It's going to help you lift your performance and minimize the volatility drag. So that's basically how I do it.
From my perspective, I mean, if we're talking about pure vol, as in the vega in options and trading, vol itself as an asset class, it is just that, an asset class with a different type of return stream that you can add into your portfolio that makes you more diversified. To me, it's another family of strategies that you could implement that have relatively well documented effects. And like Bruno was saying, it can help smooth out your returns, even if you just think of it in the synthetic asset part, which we talked about last week. It is a uncorrelated positive expected value strategy. There's no reason not to allocate to it if you have the ability to execute against it. Obviously, it does add some complexity. Obviously, you're adding all these other different elements, but as an independent, it can stand on its own. Obviously, there's many smart funds out there that do that, And I agree with Bruno's implementation, and that it's like, okay, if you can just get most of the juice from the orange, you don't have to be super optimal. And I think that kind of follows what trend following is doing. You're not going to catch the trend from the moment it starts to the moment it ends. You just need to catch the meat in the middle. And you can kind of follow that methodology to add another aspect to your portfolio. The question, to the reader or to the listener is more for you in your portfolio and your capabilities. Is this something you can do profitably? Is this something you can research? And is this something you can execute? Because if not, then it's a moot point.
Just a question. When you say smooth out the returns, is that basically to quote unquote minimize risk, maximize profit? Or is that more in terms of, not being, having the wicks up and down in terms of your equity curve in that sense? So basically have a smoother equity curve. Or is that, yeah. So is it more about risk of ruin and, minimizing risk and maximizing profit? Or is it more for yourself in terms of not having to see it going up and down that much? I don't know if that makes sense.
It makes perfect sense. That's exactly the point. So is it just something stupid that I'm doing because I want to play God and I'm a delusional guy that lives for controlling everything, or is there something here that requires a more active management of volatility? Is obviously the latter in my view. And as you said, risk of ruin. So without going into Kelly again and all these optimal sizing of bets and stuff like that, which we've talked about before. But the nugget I'm giving you, the reason why Sharpe ratio again is such a chimera, but it's such a lovely idea, is because there is a direct correlation. No, there's a causation actually between the magnitude of your Sharpe ratio and your ability to take risk. What do I mean by that? If I really had a two or three or four or five strategy Sharpe, my risk of ruin by definition would be plummeting relative to a 0.5 or a 1 Sharpe. Where is the problem? And I don't want to get into the old debate, but our industry has really played a dangerous game, because biggest asset gatherers mostly and all these convergent strategies are trading second moments, i.e. volatility and variance, for higher moments. So you have this illusion of high Sharpe ratio, but in reality you don't. And then one day you're going to hit you're going to be hit by a massively negatively skewed event and go out of business. However, there is, and you don't need to be a high a PhD or something like that, but there is a strong and reliable body of work that points out that the more Sharpe ratio, the less volatility you have in your returns, the higher is your ability to sustain leverage, which we don't talk about a lot, but leverage is really important, and volatility. So yeah, it's really about risk management. It's not about illusion of control. It's not about vanity. It's none of these things. I do think that volatility matters, but obviously you need to temper that. Am I worrying about every nook and cranny of the market moving? No, I am trying to manage for certain thresholds and triggers. So I don't sweat bullets every time my portfolio moves 1% against me, and I'm running at a quite high volatility, by the way, as well.
Yeah, when I hear the word smooth equity curve, the only reason I dislike that term smooth equity curve is I love these outliers. So I love these beneficial step ups in the equity curve. What I don't like are the drawdowns that are interdispersed between these massive nonlinear step ups in my equity curve. So I don't want to necessarily get a straight line out of this, but what I do want to do is I want to hitch up my drawdown exposure. And that's where I'm almost willing to entertain these ideas that you're talking about using options in the long vol sort of in the short term space to sort of give that extra punchiness, which naturally would not compromise those outliers. It wouldn't compromise the step ups. It would perhaps lift up those drawdowns so that that overall asymmetrical equity curve that's produced would just ramp up under compounding. So that's what I'm thinking about. The reason I'm willing to entertain it is we're not talking about volatility targeting. We're not talking about taking profits off the table. That's where I get concerned with these discussions where we start compromising the letting profits run component of our mantra. But I certainly would possibly consider, for March 2020, that massive move in the markets, or February 2020, I would have liked to have significantly ramped up my short-term exposure with options to catch that move, because I just inherently feel that as markets get more and more volatile over time, the future is more and more uncertain. I think we're going to get more and more of these sharp shock episodes before we might get these major corrections. So that's why I'm willing to entertain these ideas.
And I mean, I think that you hit the nail right on the head, Richard. These things are not mutually exclusive, and I think that they should be entertained. It's not, seriously, because um, long vol or buying options, or however you want to put it, you still can follow all of the golden rules of trend following, and in fact, they are designed by design to follow the golden rules, because a call or a put will increase its exposure as it goes in your favor and decrease its exposure as things go against you. So necessarily, by mathematical design, they are like the instantaneous version of multiple systems at that point. So if you reframe it like that, then you're able to, I think, get a better link from vol space to trend following space.
Nice, exactly. So you talked about one of the problems with options is this: it's an incredibly vast volatility landscape, as you've already talked about, and how difficult it is under optimization because it's such a vast landscape. But I'm wondering, Derek mentioned, the use of strategy ideation as a way to plug the gaps or the weaknesses of your portfolio. So if you're looking at a small component of that option landscape that sort of plugs that weakness in your portfolio, does that reduce significantly the optimization problem?
Yeah, it does. It does. But and this is what I was referring to when I said you need to come up with a suite of optimizers and let them go and search the space, because you're absolutely right that thinking about a payout, because in effect, another way I just thought about another way of saying is that I completely second Derek's comment that volatility should be traded from a vega standpoint and not the delta, because our delta comes from the trend followers. But still, you have such a huge space to search space that thinking about a target payout or a collection of payouts helps you out narrowing the field a little bit. And that's why I'm saying I'm weeding out lots of strikes. I'm weeding out lots of different products and sub-products. I try to keep it as simple as possible because my search space is so huge. And of course, combinatorial optimization here doesn't work. Of course, it's impossible. So you have to have some sort of heuristic based and stochastic. And once again, our good friend Bayes, the Reverend, comes to us rescue, and you sort of build models that help you not only weeding out and restraining the search space, but getting to the target more efficiently and faster, or as fast as possible.
Thanks, Bruno.
Well, I want to pick on Bruno a little bit and fulfill my role as the defender of classic trend following, simple classic trend following. And I was getting very confused earlier, Bruno, because I was getting this impression that earlier that you were a little bit different than we've heard before, and that I was getting this impression that you would trade, you would not pay attention to vol or if it wasn't, if it only centered around this idea of building a business. But then I was thinking, no. Bruno prefers. It's not just building a business and doing what clients want. I think you actually do prefer, like, as you just said, that, and you think that paying attention of all is something that we should do, and you prefer to do that. And so, however, this statement you made, how we get there matters. The thing that popped into my head was, where is there? Where is there? There for me is the returns and making the most amount of money. And so that's where I want to go. That's my there. And then it reminds me of that Spitznagel article, or multiple articles that I've tweeted about over the past few weeks. He built a really good case, certainly a better case than me, although I don't think he really likes trend following necessarily, or understands diversification from a trend following point of view. And of course, even though we want to maximize these returns above worrying about volatility, we of course know that how we get there kind of does matter, but not obsessing over it every day and not building volatility concerns and smoothness concerns into every day and a staple of how we are going to handle the markets. But the trend following, classic trend following places, staying in the game and not having these fatal drawdowns, whether it be minus 10% or minus 20% for some clients, or minus 50% for other types of clients, that we know that staying in the game is keeping the account, keeping the client happy, not losing all of your money. So that there's nothing that concerns the classic trend followers more than that, and nothing that concerns us less than volatility, especially volatility in the context of massive open profits.
Yeah, so thank you very much for everything you said. And again, I remember you Richard tweeting about Spitznagel's volatility, schmolatility. So yeah, I get that. Also, I am very aware that my language is not as precise as I would like it to be. So I apologize that you sound like that I managed to confuse you, but unfortunately I do that regularly to a lot of people. So let me put right the imprecisions and try to clarify what I meant by. I think I'm going to start from the end. Do I worry about daily volatility, and do I sweat bullets if my portfolio dances around my target returns? And the answer is absolutely no. And unquestionably, I don't care. Where do I start to care? And what in one of our episodes, we decided to shy away from correlation, from this nomenclature, and we started talking about second moment matrices and downside volatility and things like that. And again, I am going to call out another wonderful tweet of yours, Jerry, and is about the guy that manages the EMC fund. In there, he talks about utility function, and so being an optimizer, I always think about my utility function, and what that guy was doing resounded a lot with me, because it's exactly what we're doing. I have an asymmetric volatility function. What do I mean by that? I don't care about upside volatility. I love it as much as you guys do. I only care about downside volatility. I don't even care about downside volatility the same way, meaning the first X%, 2, 3, 4% doesn't bother me. When it gets from 5 to 10, I am getting a bit worried. When it goes to 5, I can't, from 10 to 20 is a problem. Further away is the end of everything. So
I think we lost you there for a second, Bruno.
He was on a roll too. I was nodding my head as he was talking.
I worry a lot about the downside. When the downside gets very downsidey, I get very, very worried. When the downside gets, uninterested, I go back to sleep. When the downside is upside, I love it. I try to maximize that as much as possible. I know, being a realist, that you can't, isolate and manage the downside without giving up of some of the upside on the other side of the coin. So, but I'm constantly trying to create that utility function that is coherent with my view of the world. And then I am living in a accounting world, in a modeling world, in a framework that should be coherent with my view of the world, and it should help me realizing my objective function, my utility function. Ergodicity and all the wonderful things that we talked about are disturbance factors. So, I fail more often than I am successful. But my premise is trying to do trend following exactly like you guys do. So, I don't think Derek said it before, and I completely subscribe to his point of view. I don't think our approaches are, alternative or antagonist, but there's a lot of complementarity in what we do. You are striving for the upside, and I am unfortunately losing some of that, but I am trying to control the downside as aggressively as I can. Your way to control the downside is trade small. My way to control the downside is explicit and objective function and try to optimize that. Why? Because I think that we always and inevitably undertrade our winners and overtrade our losers. The problem is we can't identify with winners and losers ex ante, but I can ex ante identify a utility function or some sort of functional form that describes my psychology and my approach to risk. That's what I'm trying to do. Everything else is a reflection of that. And I don't think, even if we disagree on this, but I don't think that doing this compromises my ability to hunt for outliers and realize outliers.
Yeah, I see where you're coming from, Bruno, and yeah, eloquently put. And we are on the same mission, exactly the same mission, I suppose, where the only difference is that we would say perhaps that do we need to go to this level of complexity to achieve your outcome when we've already got a technique with a very sort of simplistic technique that achieves an outcome? Is it worth the cost of all of that effort of what you're going into? But I certainly do see a weakness in our trend following models in that short term space. And if there is a solution for that by dipping into a bit of complexity, I'm sort of tending to say, well, maybe I do dip my toes into that water.
Yeah, I'm probably a bad example because you think I'm overcomplicating a lot of things, but I don't know. It's funny because, okay, let me tell you how I approached this whole trend following thing. I obviously read about the turtles and I fantasized about them. I went and took it to the computer, and this was 09, 08, 09. Programmed it up, and I saw that the performance was fantastic in the 80s and then degraded through the 90s a little bit. Then it had a wonderful kick up towards the turn of the millennium. And then after going into 05, 06 was decisively meh. And then it seemed to sort of have lost its weight a little bit. And I started thinking, okay, obviously it was a portfolio of, I don't know, 40, 50 contracts, mainly financials. And then I started thinking, okay, there might be something about the instruments. And then Jerry proves the fact that you need to keep expanding your investable base in order to recover those wonderful properties. But at the time, I started reading and learning about, as Jerry puts it, the European way of doing things and this vol targeting. And it seemed a lot more in tune with how I think about risk. And that's why I sort of went down that route, and still found a lot of interest in for the classic ways of doing business. But I sort of embraced this complication and sort of lived with it. But my stories are stories of many failures, rather than having found the key. And I don't believe I will ever find it, but I'm sort of adapted and grown, around it a little bit.
Yeah, we always kind of circle back to this conversation in this clubhouse, and I wonder how much of it is perspective, how much of it is language, because Bruno and I think, are probably more on the same page, while Richard and Jerry are on their same page. But we are both targeting the same destination. We're controlling risk in the way that allows us to capture this strategy. We do believe we should cut losers. Um, but the methods that we use, or the roads that we take to get there, are different. And then that creates some kind of dispersion. And I think that, part of it is the business case, but also a philosophical case. Um, Having the view that optimization or portfolio theory, or just thinking about things as a portfolio versus a building blocks of trades, is a massive difference. And I did tweet about that, although maybe slightly poignantly at the end. But I do think that that kind of factors in how you see the world. It's not necessarily in the end game going to be that different. Um, what I do see, though, is what you do to make that happen, right? Like, I don't know, I'm babbling a bit here.
No, I see where you're coming from. It is a philosophical difference. One tries to orchestrate an outcome, which I would regard you, Derek, and Bruno as being in that camp. But and perhaps Jerry, I can't speak for him, but I tend to rely on this principle that this is a behavior that happens with markets. You don't need to orchestrate an outcome. You just need this rules-based process, systematic rules-based process, and the outcome is delivered by virtue of the nature of that market. I don't sort of orchestrate an outcome. I leave it in the hands of the market to dictate my fate. So, when you're writing a significant outlier, you can sort of pat yourself on the back and say, well, I had a strong role in delivering this outcome through my process. On the other hand, when I write this outlier, I say to myself, gosh, that's fantastic. The market's delivered that to me. I had no role or sort of no sort of orchestral role in delivering that outcome. It just happens to me because I'm applying this, robust empirical process. That's the sort of difference. But really, the outcomes are pretty well. I'd assume they're the same outcomes.
I mean, I don't think I'm trying to orchestrate anything. I think my entire a theory of trading is I know I don't know. Um, and I'm definitely not patting myself on the back, although I have tried to distance my P&L with my identity, and my identity as a trader, uh, over these years. The tools and the framework that we use to harness something that is ergodic, random, but has these recurring phenomenon, I believe that is the same. And to say that one method is not empirical, or using research or the other, I don't think that's uh, necessarily what was implied. But I will say, though, the bumpers that we put around our strategy that try to protect us from crashes. And I mean, I don't mean like market crashes or P&L crashes, maybe P&L crashes, but like what we perceive as our ways to funnel risk, to control risk, and to protect ourselves from these random movements in order to survive and to have a low enough risk of ruin that we can continue to play the game, is the difference. It's like you have two different tradesmen. They might approach making a table a different way, but in the end, they're both trying to target a table. I'm definitely a nerd, so me trying to name things, tools that are in your shed, is not necessarily great. But a lathe versus a table saw is something to complete the objective, which in the end I think is the same. So how you build those bumpers and how you funnel that, to deliver to the client, is also part of that narrative, right? the narrative of the product that you're delivering. And I think that that's where the I don't want to speak for the European CTAs, and I'm definitely not European. But the idea that, like, we had mentioned earlier today, that we can stand on the shoulders of giants and their research. There are a lot of tools out there. Once you start thinking about things in the portfolio way, once you start thinking about things as synthetic assets, once you start thinking about things as having some kind of dependence, I mean, you could honestly measure it with correlation and you'd be like 65% there, and what's the issues. And if you could deal with these specific issues, then you could probably be, 80% there, just like people still use Black Scholes. But the idea is, how do you want to build those bumpers around yourself and your clients? To deliver that is different, because we find that our optimization function versus just thinking about each individual trade, I don't think I really know what trend is going to happen next.
No, definitely. We can't. The only thing first of all, thank you both, Richard and Jerry, for calling me out, checking me out, trying to always pick on stupid things that I say, because it really, really helps me in articulating my story and explaining what I do to people and advancing our collective knowledge. But the point is this: I think you guys have this idea that we try to be clever about it. On the contrary, I am an idiot. Warren Buffett was thinking, perhaps not knowingly, unknowingly, but he was speaking about me. I'm the idiot that needs diversification. I am the stupid that doesn't know where the next big theme is coming from. So I sort of have to put a lot of things together and make sure that nicely fit together. My fruit basket, fruit salad analogy. I need to chop up apples and oranges, but I also need to temper apples versus oranges. They need to have the right balance between sweet and and sour. Otherwise, my fruit salad is gonna taste horribly. You guys, you Richard and Jerry, don't care about fruit salads. You care about fruit baskets. You just need color, and you need that your basket to look nice. It's a slightly different thing, but we are trying to deliver a good dessert to our whoever our clients. That's the same thing. So the aim is the same. The way we go about it is different. But I certainly don't do these kind of things because I want to feel clever. I'm as much as an idiot as they come. But I actually, perhaps it was my strong structuring background, but I was brought up to think about how things fit together, trying to always see the other side of things, trying to always figure out who might help you or hinder you in your trade, and as Derek says, trying not to make the portfolio crash and all these kind of things, which in the end make you do things slightly differently. But again, I don't think we're trying to control markets, predict outcomes of trades, or even curtail the positive skew of trends. We all want the same. And more to the point of Jerry, what is there for me in terms of returns is being able to just achieve what I want to achieve in my 3 years, 5 years, and hopefully longer terms. As Richard, another wonderful tweet by Richard, this idea of the North Pole and the 90-day plan. My volatility targeting is my 90-day plan. I thought about it and said, that's it. I'm gonna say it if I can have the opportunity. And thank you for giving me the opportunity. I'm gonna say it in Clubhouse next, because this vol targeting, this portfolio optimization, management, maintenance, structuring, however you want to call it, compilation, is what helps me keeping my downside in check. Much in the same way as Jerry's ability, because I think it's Jerry's number one ability to sort of open Twitter and find the next outliers like that, or open Google Alert and find the next idea to to push for. I am decisively weak at that. I need a lot of struggle to come up to come up with a good idea or anything like that.
Well, here's a kumbaya moment, Bruno. You guys make me look stupid.
No, I want to retain my stupid crown now.
No, I think it's good that we have these two types of views that are always oscillating between each other, because if everyone agreed, our conversations would be really boring. From my perspective, I like the pushback as much as anything else. I like the views. You guys have no idea what it's like to be the only systematic guy surrounded by discretionary people all the time. It's why I love coming to. I made this clubhouse. Following on Jerry's clubhouse. I love going to Jerry's clubhouse. I love Twitter, even though I really only started using it, even though my account is quite old. It was hacked by Russians at some point. So like, I only reactivated, got it back over the summer because of how important this dialogue is. And even we stray from the main idea, of today, I think we always get to somewhere really interesting. And how to make this applicable to all the people in the audience. I mean, obviously, it's always open to have people come up from the audience, but I hope that this tension, central tension between these two groups, really does spin out a lot of good conversation.
Yeah, and more to the point, I can't wait for Jerry's and Rob's battling out with Niels next time they go on together, because now Jerry has a lot of good ideas and good tips to confront Rob on, because I think at times that conversation was very much territorial, and it seemed like they had to sort of mark the fact that they had strong distinctions and strong differences, when in actual fact I think a combination of trying to be cute versus being able to spot trends before others is really what could win the day in this space.
Oh my
Yep.
gosh, I just imagined like listen this clubhouses, and then we play the Rocky theme song and we prepare Jerry for his battle into the next podcast. Oh my goodness.
I think we should start calling it
Why
Fight Club. When Jerry gets on with Niels and Rob, I think we call it Fight Club. I sit there in the background, I'm just rooting for Jerry. I'm saying, go, Jerry! Hammer him! Hammer him!
You're making me laugh. But I know I need to. We need to do a live thing with Rob, Niels, and me, and whoever, everyone. We need to all do a live get together, and I think that's a different dynamic. We can see each other on the Niels Top Traders Unplugged podcast, but we're not. I think showing it live on a Zoom or a webinar or on stage in Vegas. I think that would be quite fun. However, I have the same, and this is just my opinion, and it happens, in my opinion, all the time, but I have these same things that I have 5 things that I believe in, and no matter what anyone says, I twist it in a way in my mind that, okay, just pick out one of these 5 principles, Jerry, that you believe in, and answer this question. And whether it's right or not, that's how I do it. So sample size, of course, is number 1, I guess. And so I'll talk to Rob or anyone basically, and that's what I'll say. Well, sample size. And but we never get to the issue. It's like no one ever says, "Oh yeah, darn, you're right, sample size. I really need to think about that." Yeah, you've got me on that one, and you keep mentioning it, and I don't want you to keep mentioning it without a good comeback. And when someone gets me, because I have been gotten before, and tongue-tied and not able to respond, I'm like, I just write it down and I'm going to deal with this. And it's not going to happen again. And I'm not going to let it go. They got me, but I'm going to come back with what I should have said. It's like that Seinfeld thing where George keeps thinking, of what he should have said to someone who said something to him. And he keeps trying to go back and confront this person with with what he really wants, what he really wish he would have said, and that's what I do. So, and so I think that on some of these core principles, um, I wish that people would confront me and say, no, you're just dead wrong. You're overdoing this sample size thing, and here's why. Because I don't feel like I'm always getting put in my place, or I just walk away thinking, well, then I am right about sample size because no one ever comes down hard on me and puts me in my place.
Yeah, a live video session would be good, Jerry.
I'd be the first one to buy a ticket. That would be awesome. Can I get ringside seats?
I like that.
Well, guys, I mean, I will leave it open. I mean, do we have any other topics to discuss? Otherwise, I think we can wrap up. It's slowing down a bit.
No, I think today was probably the best. We talked about very deep and important things. So, I'd be very happy to call it a day.
All right, everyone. Thank you for coming to the Clubhouse Quantitative Brainstorm. I'm glad for everyone in the audience. Again, please DM me, reply to my tweets for new subjects you would like to see on the show, and then I will put up the voting. Although I got to get better at tweeting other stuff that's not related to this Clubhouse, but I always struggle to come up with those ideas as well because I basically drain all my good ideas for the Clubhouse. But yeah, hope to see you guys next week.
Thanks,
See you,
Derek.
everyone.
Thank you.
Thank you, everyone.
Thanks.
Bye.
Thank you. Bye-bye.